Hey everyone, and welcome to The Explainer. Look, if you're setting up a portfolio that's intended to run for decades, maybe you're exploring a 529 college savings plan or a custodial account for a baby who's just starting out, you absolutely need to understand the hidden mechanics of the market. When you're investing for a newborn, you have this incredible, unprecedented 50 or 60-year time horizon. But as we're going to find out today, over that massive time frame, tiny, almost invisible frictions will compound to either build an absolute fortune or silently kill your wealth. Let's dive in.
Okay, so picture this. You open a brokerage account, and you're immediately hit with this confusing alphabet soup of ticker symbols, right? VOO, FXIX, VTI. Honestly, they all seemingly do the exact same thing, which is just tracking the broad U.S. stock market. So if you're just looking to buy the market for your own retirement or stash some money away for your child's future, does it actually matter which one you click buy on? Well, the short answer is yes, it matters a whole lot.
Now, you might actually be familiar with this popular mantra from the Bogleheads community on Reddit, VT and chill. VT stands for the Vanguard Total World Stock ETF. And the philosophy here is brilliantly simple, really. You just buy a low-cost, globally diversified index fund, set your contributions on complete autopilot, and you don't touch it. It's a fantastic baseline, and honestly, for many, it's totally enough. But if we want to truly optimize our compounding engines, especially for those multi-decade timelines we have with kids, we really need to look a bit beneath the surface.
So let's jump straight into Section 1, the friction of fees. When funds are tracking the exact same underlying index, the absolute most immediate difference to your bottom line is the expense ratio. I know, it sounds incredibly small, right? A fraction of a percent here or there. But look at how stark this contrast is when you actually scale it up. Based on a great breakdown from Physician on Fire, if you have a $1 million portfolio evenly split into a US, international, and bond setup, your actual costs vary wildly. With Fidelity's zero funds, you pay just $83 a year. Moving to Vanguard's ETFs, that jumps to $467. And Vanguard's Admiral Mutual Funds, you're looking at $667 a year. Over a baby's 50-year investing timeline, that difference turns into hundreds of thousands of dollars just quietly leaking out of your portfolio.
And keep in mind, those are just the low-cost passive options. When we contrast the incredible efficiency of passive index funds with traditional active management, the friction from fees becomes this massive drag. It's like pulling a parachute behind you. Active managers charge higher baseline fees, sure, but they also create internal friction through constant buying and selling within the fund itself.
To see just how extreme this can actually get, let's consider the Hussman Strategic Total Return Fund, ticker symbol HSTRX. This actively managed fund has a massive portfolio turnover rate of 270%. What that literally means is the manager is churning through the equivalent of the entire portfolio's holdings almost 3 times a single year. All that nonstop trading creates excessive, costly friction compared to a standard low-turnover index fund.
So the million-dollar question, does all that frantic activity actually pay off? Well, the data pretty loudly says no. Despite a 0.77% net expense ratio and all that constant trading, Morningstar data shows the Hussman Fund's 10-year annualized return sits at just 5.03%. Over that exact same period, the simple, boring, passive S&P 500 delivered 15.51% annualized. High turnover and active fees just routinely fail to outpace simple, low-cost index funds over the long run.
Moving right along to Section 2, mutual funds versus ETFs.
So, avoiding active management isn't your only structural choice here. The specific vehicle you use to hold your assets matters immensely. Here's a really clear breakdown. Mutual funds, like Schwab's SWTSX, are priced and traded only once, right at the end of the day. They can come with annoying broker restrictions, and, crucially, they are highly vulnerable to passing capital gains distributions directly onto you. On the flip side, ETFs, like VOO, trade intraday just like regular stocks. They're highly portable, and they have a unique structure that makes them incredibly tax efficient.
And you know, that portability is a massive, practical, everyday benefit. As one Bogleheads user accurately pointed out, ETFs are not broker-specific, meaning if you buy VTI at one brokerage today and say 20 years from now you decide to move your kids' accounts to another firm, you literally just transfer the assets in kind. You won't be forced to sell your holdings and trigger some massive taxable event. You're never locked in.
Which leads us perfectly into Section 3, winning the tax game. Inside a taxable brokerage account, tax efficiency is the ultimate silent killer. I mean, it can easily outweigh a slightly lower expense ratio. Let's look at Vanguard as a prime example here. As discussed over on Physician on Fire, Vanguard actually holds a unique corporate structure that gives its mutual funds a massive tax advantage over competitors in taxable accounts. It saves investors between 30 to 40 basis points per year compared to equivalent funds. Now, when we normally agonize over just 1 or 2 basis points in fees, a 40 basis point tax savings is absolutely huge. Let's see how this builds into a really practical strategy, leveraging some great insights from Mezi. This concept is called tax allocation. Step 1. Place your mutual funds over in your tax-advantaged accounts. Think your 401k, your IRA, or that shiny new 529 plan you're setting up for the baby. These accounts naturally shield you from capital gains. Then step 2, place your ETFs in your regular taxable brokerage accounts so you can leverage their inherently tax-efficient structure. If you get this wrong, you can completely fall into what is known as the distribution trap. Just imagine this. Buying into a mutual fund in a taxable account right near the end of the year, just before they happen to issue a capital gains distribution. You will literally be handed a tax bill for gains the fund made earlier in the year, gains you weren't even invested for and didn't personally realize. It's super frustrating, and it is exactly why ETFs are generally the much safer play for taxable accounts.
And finally, Section 4, the factor investing alternative. So we've minimized fees, we've optimized our fund structures, and we've located our assets super efficiently. For most people, honestly, that's where the journey happily ends. But if you're looking for higher expected returns, I really love this quote from Ark Royal Wealth Management. Reasonable and optimal aren't always the same thing. Buying a standard S&P 500 index fund is incredibly reasonable, but is it mathematically optimal for a portfolio that has literally decades to grow?
Enter factor investing. This is a fascinating scientific alternative heavily popularized by Dimensional Fund Advisors, or DFA, which was founded on the research of Nobel Prize-winning economist Eugene Fama. And to be clear, this isn't market timing, and it isn't picking hot stocks on a whim. It is pure financial science. It's all about systematically tilting a portfolio towards specific characteristics that history shows carry higher expected returns.
According to nearly a century of market data, there are 3 specific dimensions that consistently outperform standard broad market indexing over long investment horizons. And these are small-cap companies, value stocks, and companies with high profitability. Instead of just owning absolutely everything based on how big the company is, which is exactly what the S&P 500 does, factor funds intentionally tilt your exposure directly toward these 3 dimensions.
But what's really fascinating is how these factor funds operate behind the scenes to avoid friction. See, traditional index funds suffer from this invisible index tax. When a new stock is added to the S&P 500, every single index fund must blindly buy it on the exact same day, which totally drives the price up. DFA factor funds, however, don't have those strict tracking constraints. They utilize flexible trading, acting kind of like a patient hunter. They can wait days or even weeks to execute trades at way better prices, completely avoiding that forced buying friction.
Furthermore, traditional index funds might only rebalance once or twice a year. But factor funds? They manage their risk exposures daily. Think of it like a mechanic continuously monitoring a high-performance engine, making tiny little daily tweaks to keep it running perfectly, rather than just checking the oil once a year and hoping for the best. It is a highly disciplined, scientifically driven approach to capturing returns while actively managing the friction of the market.
So, bringing it all together, ultimately, whether you are managing your own retirement accounts or setting up a 529 plan for a baby that will compound for 50 or 60 years to come, the mechanics matter. You really have to look past the ticker symbols. So I'll leave you with this final thought to chew on. Are you building a portfolio just to match the market, or are you engineering one to outsmart the friction? Thanks so much for joining me on this explainer, and I'll catch you in the next one.